Have you ever stretched a rubber band as far as it can go? You can feel the tension building. The harder you pull, the stronger the force that wants to snap it back to its original shape the second you let it go. Stock prices actually work the exact same way. Look at this diagram. Financial markets don't move in a single straight line. Instead, prices bounce up and down around an average point over time. Think of that middle line as the market's resting state. But sometimes a scary news headline hits. Maybe it's a spike in interest rates or a geopolitical event. People get spooked. One person sells, which pushes the price down, scaring the next person into selling. Suddenly, you have a stampede, and investors start dumping shares of perfectly healthy companies. If a company like Apple or Google is still making great products and earning solid profits, the business itself hasn't suddenly broken. The steep drop in the stock price is just an emotional overreaction from the crowd. When the price stop plummets way below the average line, it stretches the band. The further down it gets pulled, the stronger the mathematical force snapping it back up. In trading, this is called mean reversion. While everyday investors are running for the exits, professional traders look at this panic as a temporary discount. They step in, buy the healthy stock while it is heavily underpriced, and wait for the inevitable snapback. To do this safely, you cannot rely on gut feelings. You need exact mathematical rules. Rule number 1, only buy stocks that are already moving steadily upwards over the long haul. On this chart, we use this black line, representing the 200-day moving average, to check the trend. We only look at stocks sitting comfortably above this line. If a stock falls for months and sits below its long-term average, we ignore it completely. A company in a permanent decline isn't a stretched rubber band, it's a broken one. A cheap stock can easily keep getting cheaper. Once we have a healthy, upward trending stock, we need rule number 2. We have to mathematically pinpoint the exact moment the stock price is stretched too far downwards. Look at these two glowing green lines bracketing the price. These are called Bollinger Bands, and they act as the outer boundaries of our rubber band stretch. We cast these bands wide to catch extreme moves. You wait for the end of the trading day. If the closing price dips completely below this bottom green line, tension is maxed out. By combining these two rules, you ensure you are only looking at thriving companies, and you catch the exact moment the market has unfairly punished their stock price. But we don't jump in immediately. When the market is scared, prices can slide slightly further. Rule number 3 tells us to wait and set a trap slightly below that closing price. Here is the exact calculation. Let's say the stock closed at exactly $100. You take that $100 and multiply it by 0.97. That gives you $97. You then tell your broker to buy the stock only if it hits that $97 mark. You are demanding a strict 3% discount. Let's assume the price drops. Your trap is sprung, and you now own the stock. Now you need rule number 4, an objective exit strategy. You need a signal telling you the rubber band has snapped back to its relaxed state. We use an indicator called the RSI, which stands for Relative Strength Index. Think of this dial right here as a pressure gauge. It measures how fast the stock is bouncing back up. You watch this gauge. The moment it crosses above the 50 mark, the panic is over, and you sell the stock to collect your profit. If it never bounces and 10 days pass, you also sell. That 10-day limit is your fail-safe, cutting your losses before things get worse. Notice how there is zero guesswork here. You have exact numbers telling you when to enter and when to exit, which keeps your own fear and greed completely out of the process. Warning tone. But even with perfect math, one wrong move can hurt you. If you take all your trading money and dump it into a single stock that happens to collapse, your portfolio will be devastated. That brings us to risk management. Look at this chart. You must divide your money and never put more than 20% into any single stock. This means holding a maximum of 5 stocks, and you use your own cash, no borrowed money. By spreading your bets across 5 different positions, a sudden loss on one stock is reduced to a tiny, manageable dent in your overall account, meaning you live to trade another day. You also need to understand what winning looks like. Over 25 years of historical data, this strategy wins about 2/3 of the time, but the individual profits are small, maybe 2 or 3% per trade. You are not going to catch massive viral trends that double your money overnight. Instead, you are looking for a steady, continuous drip of small profits that add up safely over time. Now, let's talk about the hardest part. Because you win about 70% of the time, that means you lose 30% of the time. Eventually, those losses will clump together, and you might face 5, 6, or 7 losing trades in a row. When that happens, your brain will scream that the system is broken. It isn't. Those losing streaks are completely normal. They are simply the mathematical price of admission for playing the long game. The professionals survive these bleak periods because they trust their data. They know the math has been tested over decades, so they turn off their emotions and execute the next trade. They also don't rely on just one trick. Professionals run multiple systems at the same time, combining this strategy with others, like trend following, so they can keep making money whether the whole market is resting, dropping, or booming. The whole process boils down to this sequence. You identify a healthy, upward-moving stock. You wait for the crowd to panic. The price drops below your limits, hits your trap, and you buy the mathematical overreaction. Then you sell the bounce. You don't need a crystal ball to make money in the markets. You just need the patience to wait for everyone else to panic and the discipline to follow the math.